Hey everyone, Chris Johnson with Money Morning, and I'm excited about the interview that I've got lined up for you today. It's Mark LoPresti from Market Rebellion. That's right, he's the CEO of the firm. He's also an options expert. You've seen him on CNBC, CNN, and Fox Business News. All of those connections help to give us a little more inside information on what's going on with the market. We're talking interest rates, the Fed, jobs, everything that goes in as we head into October and the most volatile month of the year. Get ready, get your pen and paper, and let's jump into it right now. All right, I have got the famed. Can I say that, Mark? Can I say it?
You can call me whatever you want. We're friends, just as long as it's not, not fit for television.
That's right. We'll keep it fit for tel. Mark LoPresti with Market Rebellion, as you can see behind him with the big screen, and he's got a really neat little Oriental rug mouse pad, and I love it. Yep. So, Mark, last time we talked a little bit about the nuclear industry, specifically the SMRs out there. I want to re-hit that again because there's been some activity there. I also want to pick your brain on quantum computing. First, let's talk about what everybody else is talking about, which means it's not really that important, but interest rates. We saw the Fed drop interest rates 25 beeps. It was planned. I mean, this is a better playbook than the Bengals had or anybody else over the weekend, but it's failing. You know, it's not impressed just like the Bengals. What's your outlook here? I mean, it's the $64,000 question, but what is going to happen? We got some Fed governors that are coming out a little bit dovish today. What's going on?
Yeah, we had some very dovish commentary this morning that was putting a little bit of pressure on the equity markets coming off of what was an incredible week, another record setter for the S&P and for the Nasdaq. The Russell didn't get the trifecta for that one. There was a little bit of selling pressure, but then again, many of the stocks in the Russell also have been on fire. So when you take profit, when you sell off, what do you sell? Well, CJ, you sell the stuff that was up the most. It ain't rocket science. Also, a little bit of seasonality this week. This particular week in September has historically been the worst week for equities. That trend does tend to continue, does tend to play out. But yeah, listen, traders, investors, market watchers still digesting the results of last week's FOMC meeting, which, as you said, we got, which we thought was going to be a virtual certainty, our first critical 25 basis point rate cut to that Fed funds rate after 9 long months of the Fed sitting on their hands as Too Late J. Powell and the rest of the Board of Governors debate the trajectory of the economy. And look, you know, what was really interesting to me was not in the prepared remarks. The prepared remarks are always a snoozer. It's always the same. We're data dependent. We've got our dot plot. We're pushing towards the 2%. You know, we're doing our best. We've got all of these, in many instances, unprecedented headwinds, but it's in the Q&A, it's in the presser that happens after the prepared remarks that we often get the nuggets of wisdom in either that dovish or hawkish tone that's so important to help us try to figure out what is coming next. And what Chairman Powell did say that to me was one of the more interesting takeaways was that we had sort of an unprecedented equilibrium in terms of monetary demand and the employment picture, which was something that the Fed was sort of grappling with. And that featured more prominently for me than it did any commentary around uncertainty related either to the impact of tariffs or continued impact and catalysts in the labor market. And look, CJ, we do have a couple things that no other Fed chair has ever had to deal with, right? And that's, I think, part of the reason why we've had this wait-and-see attitude. We have President Trump's aggressive immigration stance, which is taking a lot of jobs out of the labor market, which are also jobs that are not necessarily by and large accounted for in the numbers. So it makes that hard to track and hard to track the impacts until after you see them. We have the tariffs and the trade wars, also one could argue fairly unprecedented. I would characterize them as unprecedented, and the impacts of that still being uncertain. And then finally, you have AI, which is taking jobs out of the marketplace. There's no doubt about it. The data that we follow indicates that. The data that others follow indicate that. So interesting times to be the Fed chair. In terms of what's coming next, we've got, of course, as everyone knows, you know this because you're watching CJ's show, so you're already a smart money investor like the rest of us. We have 2 more meetings on the calendar between now and when we put on those funny New Year's Eve hats and go into 2026. I'm looking at 2 more 25 basis point cuts. And part of the reason for that is, as you point out, I mean, look, we had some really actually dovish, hawkish commentary, from a St. Louis Fed chair this morning, basically saying he doesn't see a lot of reason for further easing. He doesn't see a lot of room for additional rate cuts, actually even calling into question whether or not we'll get 2 more. But I think with a pretty good degree of certainty, we will get 2 more, but they'll be 25 and 25, not 25 and 50.
Okay. And that's kind of falling within the means of what everybody else is starting to think. You got some aggressive thinking where people were saying 50 basis points, maybe stretch to 75. And I say, you know what, if that happens, there are more problems right now. You got more lug nuts falling off the wheels on the economy, and the Fed sees them. One last question on this. How about the curveball? Is this all because of the curveball of the jobs reports? If we didn't see those job report changes, would the Fed be doing something different here? Or is this just following the book?
Yeah, so look, here's the dirty little secret or secrets about those BLS numbers. And I really get what's that old expression? It grinds my gears. It really grinds my gears that the federal government, the Treasury Department, the guys that are responsible for dictating monetary policy for the world's largest and most powerful economy are basing their jobs numbers on survey data. When I say survey data, folks, it comes to you in the mail. We all remember the mail. You have to fill it out, put it in an envelope, put a stamp on it, send that back in. You can imagine what the last time I don't remember the last time I did that, okay? It could be at least a decade ago. And then they're followed up with phone calls that mostly come in through people's lines as possible spam. So, like, what is the value of this data? It's garbage. It's literally garbage. And here's what pisses me off, CJ. I'm a data guy, as you know. I co-founded a company called Battlefin, which is still one of the world's premier data platforms for alternative data. The data, the live, real-time data to understand what's going on in the jobs market is available, and it's not that expensive. And all of the big money managers, the big hedge fund managers, the guys that are the smart money on Wall Street, they use it. They don't look at this BLS data and say that there's any value to that. Here's the other thing about the revisions. 1 million jobs eliminated from the 2024 jobs revisions. You know why that is? Because the BLS surveys are so shitty, because we all know, both the government and Wall Street knows how inaccurate they are. They have to put in these life-death assumptions. And I'm not talking about life and death of people. I'm talking about life and death of businesses. Businesses starting, businesses closing. They're all assumptions that are based on data that is, frankly speaking, so old that those assumptions are completely and totally worthless. That's why we get this revision. So it's headline grabbing, it's eye-popping, but that's why Wall Street kind of goes, and just keeps on. The bull market kept going.
No big deal. Yeah,
no big deal.
Since we are on the record, I do fill that form out whenever it comes from my small business, because it says when you open it under penalty of law, Mark. I mean, come on.
Absolutely.
The rules, right? Yeah. All right, let's move on, because, actually, I want to pick your head for just another 37 seconds on that.
Sure.
What are the 3 areas? Look, small cap didn't pop up last week, and you expect to see small cap come into the game heavy if we're expecting those interest rates to go lower. The other 3 that come through my head are REITs, smaller regional banks, because they start writing more mortgages, but we saw the long end of the curve go up, right? And then perhaps maybe the housing market, but that's kind of falling down. Lennar got downgraded today. So put all that aside, and what does Mark look at and say, hey, these are the 3 areas I want to be in until the end of the year and maybe into 2026 on this interest rate tailwind?
Yeah, so listen, I mean, you're absolutely right, and I do look at all of those indicators, and obviously the performance of the home builders. The home builders also, by the way, so closely tied to that job market and that employment picture. They're one of the largest employers in terms of by sector and industry in this country, critically important. But so much of it really comes down, CJ, to what's priced in, right? You kind of started that question in terms of the market wasn't surprised by that 25 basis point cut. I think those sectors, those industries, including the home builders, including the small regionals, not surprised, right? They had already sort of priced that in terms of the associated equities. So that's why I don't think We got a heck of a lot of bullish activity. We got some, but not what you might expect after 9 long months of absolutely no movement in monetary policy. You're absolutely right in terms of the small caps, the Russell, small companies being able to borrow at an efficient cost of capital, so critical to the big and the largest corporations and the largest employers in this economy, but particularly critical to small business. So many of them rely on those lines of credit, those revolvers, the ability to factor in some instances their AP. They're getting paid from their buyers on 30, 60, 90. The bigger your supplier, the bigger your customer, when you're a small business, the longer out they push you, right, in waiting to get paid. And also on the other end of the supply chain, the quicker you have to pay for your goods. So a small business rely on those loans. They rely on the ability to bridge that gap from when they have to pay for their COGS, their cost of goods, and when they actually get paid from their large customers, especially if you're in retail, consumer electronics, anything along those lines. So yeah, very important to bring those rates down. The reason why we're not seeing a bigger party on this news is what we were just talking about, the trepidation about what happens at the next 2 meetings. And if we hear further hawkish tone like we did from the St. Louis Fed governor this morning, we're going to see a little bit of a mute on that party.
Okay. So once again, we're back at the point where bad news could be good news in terms of interest rates going into the end of the year.
Bizarro world. Yes.
Yeah.
Bizarro world. Dogs and cats living together, CJ. Mass hysteria.
I'm gonna go get big salad right now. Mark LoPresti with Market Rebellion. Thank you very much for your time. Tell people how they can find you on the reg.
Yeah, thank you. Well, first of all, CJ, it's a pleasure and it's an honor to address your fantastic audience. You can learn more about Market Rebellion and what we do by going to www.marketrebellion.com. You can follow me on X. My handle is MXLESQ. You can listen to my show on SiriusXM Business Radio, channel 132. That's on Tuesdays and Thursdays, 10 a.m. Eastern Time, and on all those wonderful networks that we mentioned earlier.
There we go. All kinds of opportunities, including the next time you're with us, and we'll share that quantum report. Thanks again, Mark. We'll see you next time.
It's my pleasure, brother. Thank you.